Welcome. My name is Dirk Brounen, and in this research clip I would like to present to you the key results of the project Corporate Real Estate Acceptance. Let me start with the central message of this project. That's a very clear one. It claims that firms need to talk real estate soon. And let me elaborate in the next 5 minutes why that is the case. This story starts in the past. The article of Zeckhauser and Silverman in 1983, Harvard Business Review, presented results that showed that companies need to rediscover their corporate real estate. Rediscover meant that a lot of companies at that moment, in 1983, were not aware of the real estate they owned and used. Now, in our investigation and our sequel, we're going to look how that is 30 years later. In the past 30 years, a lot of things have changed. We distinct 5 different stages in the literature and in the practice of corporate real estate management. The first stage is denial. That's the Zeckhauser-Silverman results that show that a lot of companies actually don't even know how much real estate they have. Then the second stage, when they rediscover, is very often anger. They are shocked by the extent of their real estate portfolio and the expenses they make. So cost cutting very often is the next step. In the third step, you'll find bargaining. Many firms at some stage find advantages, strategic advantages of having a lot of real estate at the right locations. Sometimes corporate real estate in this stage is referred to as the 5th business resource. To cut short, we would conclude in our study that the best stage to be in is stage 5, the final stage, which we refer to as corporate real estate acceptance. That is the stage in which the firm has the full overview and is capable of explaining why they have a little or a lot of real estate on balance sheet or in use. To what extent are firms in stages 1 or 5? That we measure in the 2013 survey that we did together with Cornet Global. This survey was done among 300 companies around the globe, and we asked similar questions as Zeckhauser and Silverman, so we can compare results across 3 decades and across continents. You'll find the full results in the web link below. One result I would like to highlight now is this. Why do firms still need to think about real estate? Well, actually, we asked this question. We asked companies in our survey, how much real estate do you think you own as a ratio to your balance sheet total? And very honestly, a lot of the European respondents, 35%, admitted that they don't know. They don't have a clue yet. So still, a lot of firms are clearly not in stage 5. They don't have full acceptance and overview. There are differences between the US now and in the past, and with Asia. And the full details of that you can find in the report. Now, why do firms need to talk real estate soon? Well, soon because there is a game changer coming soon, and that's called IFRS lease accounting. In the International Financial Reporting Standards, firms will be obliged to be more transparent about the real estate use. Not just the ownership, also the lease of real estate will be on balance. So the ratio of 14% balance sheet total that now relates to real estate will increase. And that will raise questions. And that will also have financial effects. The differences between companies in this respect will raise questions among stakeholders, which can be the shareholders, can be the analysts, but can also be competitors. Why do they need to talk about this? Because it's relevant. Not because it's new, it's novel because IFRS makes things more visible, but it also will have an effect on the shareholder value. The cost of capital will be affected by the real estate strategy of a firm. We look at the different value drivers in financing, that's tax rate, capital structure, dividend policy, and the cost of debt. And all of those are linked to some extent to the real estate decisions made by the firm. This we investigate in the Global 1000 study. These are the 1,000 largest firms in the world, and we look at their balance sheets and their real estate strategies. We find these interlinks. In the red bars, you'll find the real estate-rich companies in their industry. These are the companies that own a lot of real estate compared to their competitors. And they have lower tax rates, but also higher debt ratios. There are also effects on the cost of debt and dividend payout. Now, the bottom line of this research clip and this project is, well, IFRS lease accounting will soon make changes possible. It will enforce us that companies will need to think about real estate, but also have to talk about real estate soon. Real estate has financial consequences, and these effects need to be well known to the boards that need to communicate the answers that will be necessary for the questions that come. So you need to talk about real estate soon. 3 steps to get ready for this is: first, get a full overview of the real estate within the firm. Use and ownership. Think about the relative position you have in this instance compared to your competitors. Are you real estate rich or not? And then third, what will be the consequences of being real estate rich or poor compared to your competitors? Because these will be the questions that you'll get. The results in our analysis will help to formulate these answers, and the full report and paper you can find in the web link below. Thank you for your attention.